If you've been watching the stock market recently, you've likely felt the anxiety of missing out on the multi-year run in AI hardware companies. The straightforward play of buying well-known chip manufacturers has matured. Market participants are moving into a more selective phase. This graph shows the shift in hardware valuations. After steep growth, these stocks plateaued as investors demand tangible productivity gains. But look at capital expenditures. The largest tech firms are deploying $755 billion this year to build out physical infrastructure. These expenditures represent the massive physical costs of securing land, laying concrete, and wiring the data centers required to house AI hardware. This creates a dilemma. You can see the scale of the spending, but the fear of buying into a localized tech bubble after missing the first wave remains high. The investment opportunity has shifted toward the secondary waves that power and run these chips. The first wave involves the physical requirements of digital expansion, energy, and grid infrastructure. AI data centers consume roughly 10 times more power than traditional server facilities, creating a massive load on existing electrical systems. This matrix shows primary inputs for an investor: nuclear utilities, electrical transformer manufacturers, and industrial cooling systems. The outcome is capturing high-volume power demand from tech hyperscalers needing consistent electricity. The trade-off: these industrial sectors offer slower growth and lower volatility compared to tech stocks. Choosing this path means prioritizing the reliability of industrial utilities over the potential for rapid software-driven gains. Investing in Wave 1 focuses on the foundational infrastructure required to keep the AI build-out operational. Beyond the power grid, a different set of constraints is emerging inside the data center itself. This is Wave 2, specialized memory. Advanced AI processors require extremely fast data access. Without it, their processing power sits idle, creating a storage bottleneck. Back to our matrix, inputs include high-bandwidth memory manufacturers and silicon fabrication equipment providers. The outcome is benefiting from immediate supply shortages in advanced memory. However, the trade-off is significant cyclical risk, as these stocks rely on major tech capital expenditures. If those firms reduce their spending plans, the demand for these subcomponents can drop quickly, leading to rapid price corrections. Wave 2 offers high reward potential, but it requires you to monitor big tech spending very closely. As the hardware build-out reaches maturity, the focus moves to the software monetization layer. We are seeing a transition toward agentic AI, systems capable of executing multi-step tasks autonomously across an enterprise. The final matrix row shows inputs like data analytics platforms and cybersecurity systems defending these workflows. The outcome is capturing high-margin, recurring revenue from enterprise AI integration. The trade-off? High risk for localized bubbles where companies use AI merely as a buzzword. Success in this wave depends on prioritizing companies that show clear expansion in earnings per share, rather than those merely following the trend. Wave 3 offers long-term scaling potential, provided you use strict financial diligence to filter out the hype. Managing the volatility inherent in these three waves requires a plan to handle the psychological pressure of market swings. Dollar-cost averaging is a practical solution. By spacing investments over time, you avoid the risk of deploying all your capital at a single price peak. This graph illustrates how regular purchases during price swings lower your average entry price. The trade-off is you won't perfectly time the absolute bottom of a drawdown. If the market rises without correction, total returns might be lower. This strategy provides a more stable entry path in a volatile sector. Selecting a path requires an honest assessment of your portfolio goals and risk tolerance. This decision tree maps your choices based on your time horizon and how much volatility you are willing to accept. For a defensive accumulator with low risk tolerance and a 5-year horizon, software startups may be too volatile. They should focus on Wave 1 for stable yields and steady infrastructure growth. A structural optimizer taking medium risk to research fundamentals is better suited for Wave 2, targeting silicon bottlenecks. Alternatively, if anxious about volatility, choose broad market ETFs and apply dollar-cost averaging rather than picking individual stocks. The path to profit has shifted from hardware hype toward underlying infrastructure. Success now requires matching a specific structural wave to your risk reality.